Hi everyone, I'm Ross from Smith 150 Group Property Accountants and just going to look at how much the differences these interest rate changes make on property. So obviously interest rates, if we went back to the start of the year, we're looking at about a 2.29% interest rate. And just recently, ANZ and the other big banks have jumped up and it's now about 3.25%. So we're just going to look through a normal sort of rental property. What would the numbers have looked like and what are they starting to look like with this? So I'm going to share my screen and we'll have a little look at the first property I found. So this was the first new build I found just looking on Trade Me and just searching for a new build. So it's obviously new townhouses in Christchurch, 2-bedroom, 1-bathroom, inquiries are over 550,000. So your sort of new sort of properties that you'll be used to seeing. And first thing I always look at these is what is parking like? So these are 2-bedroom. How many people are you going to have in this place? Each of these, there's 8 units. There's 1 car park each. So that's the first thing I start thinking about is, you're going to have 2 bedrooms. Is there going to be at least 2 people? Well, generally, yes. Is there maybe going to be 4 people? So that's it's likely to be 2 to 4 cars. Where are all these people going to park when there's only 1 car park for each one? So I'd be looking around the neighborhood. What's the rest of the neighborhood like? Is it all getting developed the same? Where are these people going to park long term? What's going to happen to that? And just thinking that through a little bit, because most people have more than 1 car. So I would be thinking about that. Then we're looking at some information. So I got some basic information for this one. They have a sheet for what the properties are worth. So they're 469,000 if we say just look at unit 1. And then they also have a rental appraisal. So you can look, it's between 440 and 470 for that appraisal. So if we start looking at those numbers, so if we do this Christchurch townhouse example, so 569,000, then you're going to have a few costs to buy. You might get a valuation. There'll be some legal fees. You might set up a company. You might do a building inspection or something. These are brand new, so you might be less likely to do the building inspection, but there's other costs like that. You're then going to get some contribution back from the bank. So it might be $2,000 just for example. Then I always work on 100% debt. Generally, most people do not have money. You're not putting money into this. And to be most tax effective, you're not going to put money into this. You're going to try and borrow 100%. And if you do have money, always work on that afterwards. Start off 100%, see what the numbers look like. These are brand new, so you should get 52 weeks. But one of the first things I would be doing is chatting to a couple of independent property managers. So not the one who's given an appraisal, chat to a couple of different ones, just see what's the demand like in that area? What do they see it like being over the next couple of years? I think these townhouses didn't become available until July next year. So looking at, how much is getting built? What is the demand? Do people want 2-bedroom, 1-bathroom townhouses? Just sort of discussing around that and seeing what the rent is. The rent level was 440 to 470. So I work on the middle, $455 per week. That's 23,000, 24,000. So when we're looking at the gross yield, 24,000 divided by 569 gives us a 4.15% gross yield. That's sort of average. It's definitely not amazing. And Christchurch, it wasn't that long ago that we were getting 5%, and now it's slipped back. So that means your cash flow is going to be worse. We'll start with a 2.29% interest rate. We've got some accounting. I'm not sure whether this one's got a body corporate or not, but to me, there's going to be some common costs. There's going to be some common expenses in there. Looking at the picture, once I find the picture, you've got some common areas, you've got some gardens, you've got some gates, you've got some parking, driveways. There is going to be some common repairs and some upkeep, and that there's going to be some costs. So whether there's a body corporate or not, it is still going to cost you something. So I'd allow something for that. Insurance is high in Christchurch. It could be part of the body corporate are separate, but you probably are still looking $2,200 in Christchurch. Interest 2.29% just for a start. Property management in there, we've got 8%. Rates are a bit lower. they might only be about 2,000. Brand new property, so you should be low repairs, maybe $500 a year. Service your heat pumps, wash the place, few things like that. Then if you're new to property investment, maybe some seminars and education, you might join your local property investor association, a little bit of travel, let's say you're outside of Christchurch. So for this, we were looking 23,000 in, 23,000 out. We were basically break even. It's a new build, so we don't have to worry about my red line. And good thing about new builds, you get a whole lot of depreciation. You would get value it in, and they would value the carpets, the curtains, the dishwasher, stove, the heat pump, the fences, the decks, the driveways, the paths. You're going to end up with a big amount, and that's a quick guess, but that's going to give you a bigger loss for tax purposes. It's a new build, so you can still claim the interest. You're going to make a big loss for tax, pay no tax. Yeah, overall be losing $300. So I'm not so much getting into whether this is good or bad, but yeah, it's still not making money at very low interest rates. And then obviously since then, interest rates jumped up. So if we go to 3.25, which is the current rate now, so if you bought this property now, and pretty big change. It's almost $6,000 swing. So it was break even. Now what's happening is you've got 23,000 income, still the same. Your expenses jumped up to 29,000. You're now about $6,000 negative. And that's obviously the first year. So that's interest rates now. Very, very hard to pick what interest rates are going to do, but obviously most people are expecting them to go up a little bit. So if your interest rate goes up, this is going to get worse and worse. So yeah, it's really important to factor in, have a good look at what is the rental really like, what is the cash flow on the rental, and don't just go that, oh, it's a new build, I'm going to get interest deductions, it's going to be amazing. Because as you're seeing, it's not. This is just 1 year. And then what we normally do is look what's going to happen over the next 10 years. So I'm going to jump to this quickly, but yeah, so all these are other properties. We won't show those. This property, with it being brand new, you still get interest deduction, but with interest rates going up, rent going up, all that sort of thing, after tax, interest only, I've got it losing $11,000 a year. So that's nothing going to principal, average per year losing $11,000. So if you think of that over a 10-year period, you're looking at it costing you $111,000. So to me, that property is a big gamble on a big gamble, basically. You're basically gambling that it's going to go up in value. You're gambling on big capital gains. Going back to my 1 year view, this is the 1 year picture that it's going to cost $5,776. 10 years time is these figures next to it, my sort of predictions out, what will happen with rent, what will happen with expenses. It's looking like it could be 11,000 negative. And down further, I've got P&I. If you went P&I, so all those numbers were interest only. If you went principal and interest, it's minus 17,000. So really the takeaway from this is, one, new builds, look at the numbers. They're not necessarily the amazing thing that you should rush out and buy. Yeah, with today's numbers, prices jumping up so much, interest rates going up, you might find that they actually don't work and the cash flow is terrible for you. Yes, you can still claim interest, but you got to look at that overall equation and look at the overall cash flow. Two, look at what's going to happen in the future. What happens with interest rates going up? And yeah, this one we're looking at over the next 10 years, everything going up over time, it costing $11,000 interest only. And probably three, what's the risk? What happens if you're forced to go on principal and interest? So in the past, been pretty easy to stay on interest only. What happens if banks make you go P&I and you're not able to go interest only? So in this case, you'd be 17,000 negative. And while that's great, you're paying down the principal. Awesome, good place to put the money, and it's giving you more of a buffer, less interest long term. But can you afford the 17,000 a year? So yeah, really important to look at those different things, look at the effect that these interest rates have had, and yeah, huge impact on it. So yeah, be really careful out there, make sure your numbers work and really run through. To me, you can't just buy a stock standard rental. You need to buy something that's got some opportunity, something where you can subdivide, add a room, do something different to it. And if you've heard me speak for the last 5 or more years, it's up actually 17 that I've been been running Kerm Smith Property Accountants now, that you'll always hear me talk about that. It's always buy something good, buy something with added value, take your time and buy something that works. Have a strategy. If you're lucky enough to have a whole lot of cash, that can change, but you still want to buy something reasonable. You don't just want to get a tiny little return and be really gambling on capital gains. You can do a lot better than that. So to me, yeah, it's the same things. It's not, don't stop, don't not buy anything. Yeah, you still can buy things, but it's about buying right. Buy something with those added value potential. Buy something that really makes sense. You can get some better cash flow and do something from it. So hopefully you enjoy that. Thanks a lot. Bye.